Welcome back to Global Money Talk, live from the New York Stock Exchange. Joining us today for a market insight on the technology sector is Steve Milunovich, retired technology analyst and member of the Institutional Investor Analysts Hall of Fame. Steve, great to have you at the New York Stock Exchange. Thank you so much for joining me.
Oh, thanks for having me. I appreciate it.
Well, I understand that you began your career in terms of tech analysis back in 1983. And one thing that I think about when I think of 1983 is the launch of the Apple Lisa computer. So a lot has changed since then, especially when it comes to technology. We've had the advent of many new entrants when it comes to tech. So give us a little background in terms of your career.
Sure. So as you said, I started in 1983. Research at that time wasn't the place most people wanted to go work. In fact, it really didn't recruit on campus for research analysts. And yet I knew that's what I wanted to do, so I just blanketed Wall Street and managed to get a job at First Boston. And they said, would you rather cover coal or mainframe computers? And I didn't know much about either, but I figured mainframe computers probably had a better future. So I've seen many cycles, and that's what we're going to talk about today, is kind of the evolution of technology over time. And I was on the sell side. The sell side, of course, covers companies in a very concentrated way and puts together ideas for the buy side, the mutual funds and hedge funds. And although there's a lot of focus on our stock picks, the sell side really act as consultants, if you will. And so we had to think, fairly big picture, but then also bring it down to the company's specific level. A lot has changed technologically in terms of how a research analyst does their job, but as I look at it today, a lot of it's the same. People are still writing reports, still visiting companies, and technology, if anything, has certainly become much more important than when I started.
And you bring up an important point, because we think about the way that all of us use technology now and the access to a lot of these operating systems. I'm sure that has changed significantly since you first became an analyst. And because you've been through so many cycles, when it comes to technology, how do you look back on the different cycles? And could you enlighten the viewers in terms of what that looks like?
Sure. So I've got some slides that we can take a look at to look at the evolution of technology. So if we start with slide 1, this is a 60,000-foot view of the industry. So this is actually from a book by Carlota Perez called Technological Revolutions and Financial Capital, written about 25 years ago, but fairly influential. And she argues that technology drives the economy, and it does so in long-term waves of 50 to 60 years. So you can see she goes all the way back to the Industrial Revolution, the age of steam and rail, and so forth. And she divides that 50 to 60 years into two major periods. The installation period, which is one of high invention and innovation. Essentially these days we would call it a period of disruptive technologies, new technologies coming up and starting to disrupt the status quo. It also tends to lead toward the end of that installation period to a frenzy, or these days we would call it a bubble. After the bubble, you get the deployment period, and that's when these new disruptive technologies permeate the economy and create real productivity improvement. Particularly in this first period, the synergy era, that she also calls that the golden age, if you will. And that's, I think, particularly when stock investors most benefit from these new technologies. Now, if we look at the current age of information, she starts that in 1971, which is when Intel created the microprocessor. So we obviously had, gradual growth, and then in the 90s, tech really took off and ended up with the dot-com bubble. So in this era, that would have been the primary bubble. From there, it gets a little bit cloudy, because we could argue we also had a bubble with the financial crisis, which is more about mortgages and housing and so forth. But arguably, we are perhaps now in the deployment period and perhaps the synergy period. If you look at tech stock performance, certainly, and we will, it's been incredible over the last 10 to 20 years. Now, will artificial intelligence, which we'll talk about as potentially the next wave, really lead to a long synergy period before we get to maturity? Hard to say. So this is very long term, but it's good to think about 50 to 60 year waves. If we go to the next slide, we can start to get a little bit more practical. And this is looking at 10 to 15 year shifts in technology, often product driven. The trick in technology has been to basically identify the winners in a new 10 to 15 year wave and exit the older companies. The older companies don't go away, but the growth migrates to these newer names. So as you pointed out, in the 1980s when I started, it was really about mainframe computing, and then it was the PC with Compaq and Dell, networking with Novell, putting those, communicating those PCs together. And then, of course, we went into the first age of the internet, which was the desktop, which led to the dot-com bubble. And then perhaps beginning with the Apple iPhone, the mobile internet took off. And the last 10 years or so have really been about cloud and SaaS, software as a service. So it's been a very software-driven last 10 years. The question now is, what's the next wave? And over the last 5 years or so, a lot of people have been trying to guess that next wave, right? Because it's so profitable if you get it right. And it was, crypto and NFTs at first, and that didn't really happen. And then it was Web 3.0, and that's not really happened either. The consensus now is that it's generative artificial intelligence, and we'll talk more about AI. But that's the consensus in terms of what the next 10 to 15-year wave is. So you want to be looking for potential winners there.
Mm-hmm. And I think it's very helpful for all of us to take a look at these different cycles that you have mentioned in your slides, because when we think about how AI has become a hot investment theme, we think about how many decades have passed since that has come on the horizon. So I think taking a look at all these cycles is very helpful. I know you want to talk about what we're seeing right now and how to identify these names. So how do you go about doing that?
Sure. So on the next slide, slide 3, I just do want to point out that each of these waves results in a different group of companies really succeeding from a stock market standpoint. So these are the top 10 market caps by decade, going all the way back to the 80s when IBM was dominant, into the 90s when the Japanese were supposedly going to take over the world. That didn't really happen because they didn't have the software expertise. Then, of course, we had the dot-com bubble. Cisco was the second largest market cap, and I covered Cisco at the time, and I remember we wrote a report saying if Cisco grows at the expected rates at that time, it's going to be a third of GDP in 30 years, or something crazy. So you knew things were overdone. 2010 to 2020, we've had a big jump in market cap, and that's been that cloud SaaS era. And then you can see that with your help, we've just updated this recently, so you can see the current market caps. Apple still is the largest by a little bit over Microsoft. NVIDIA, of course, has come out of nowhere. And you've got other new names like Tesla. And I think our audience will be interested to see Samsung Electronics there. Samsung was there in the 2020 period as well. Still incredibly important for its semiconductor and consumer electronic franchises. So these are the names associated with the waves. And again, the goal is to sort of figure out who's going to move up and who's going to move down. Now, you were asking a bit, if we go 2 slides later to the 7 powers, you were asking, what do we look at to sort of determine which companies we might be interested in investing in? So I'm not here to give specific names today, but again, to provide a framework. And there's a lot of ways you could look at company selection. But one of the frameworks I particularly like is the so-called 7 Powers strategic framework. Hamilton Helmer wrote the book 7 Powers. He was a professor at Stanford as well as a money manager. And he argued that a power is really finding a strategy that gives you sustained differentiation, right? From a financial standpoint, we would call that a high return on capital. And the green squares here indicate the powers, 7 powers. So just to quickly enumerate them, you've got pretty obvious things like scale economics. So the bigger you are, the lower cost you can provide your product or service for. You've got network economics, which are incredibly important these days. Network effects, if you will, really have allowed these new companies like Google and so forth to get as big as they are, because the more customers you have on one side of your platform, the more you get on the other side of the platform. Switching cost is a big one in technology historically. You're usually locked into a company's architecture through software, like the IBM mainframe, which is still around today. And then you've got ones like process power, maybe TSMC, or some of the semiconductor companies have that in terms of their semiconductor process being proprietary. A cornered resource where you have proprietary access to an asset, perhaps like Corning with Gorilla Glass. And then the final 2, counterpositioning was Helmer's favorite power. It's basically going opposite the leader. So if you come into a market, do you copy the leader? Probably not going to work. So instead, you do the opposite of the leader. I used to work with a couple of marketing strategists, Al Troughton and Al Rees, who were very well known for creating the term positioning all the way back in the late 1970s. And they said business is a battle not in the marketplace, but in the customer's mind. You have to get into the customer's mind. And they said if you're not the leader, you want to go opposite. So for an example, historically would have been Avis. So think if you're going in the rental car market and Hertz is there and they're by far the biggest and the best, what do? Do you try to copy Hertz? Well, no. Instead, what you say is we try harder. We're number 2, so that's believable, right? We have to try harder. And then you point out, hey, they're number 1. They have long lines. We have short lines. Why don't you go with us? So this opposite approach, I think, can be very successful. Another example might be Vanguard, indexing instead of managed funds like Fidelity, or even Tesla doing electric cars versus combustion engines. Branding kind of fits into that as well. Once you're established, you want to have a differentiated brand, as Apple obviously has. And at the bottom of this slide is the power by time. That is, when you start a company is when you have to decide, do I have a cornered resource? Am I taking a counter-positioning strategy? As you take off, you try to take advantage of network effects, scale economies, switching cost. And then once you're well established, then you focus on branding and process power. Just to think about applying these to a company today, let's think about NVIDIA. So obviously NVIDIA, in a sense, has kind of come from nowhere, although the company's been around for a long time. So I would argue scale economics, yes, they're the biggest manufacturer of graphic processing units, but is that really such an advantage? Probably not so much. Network effects, not so much in terms of having kind of, one side of their platform attracting the other side and vice versa. That's a little bit more of an internet phenomenon. Switching cost, I would say, is one. Switching costs through their CUDA software programming. Once you get programmers used to using a particular approach in a language, they're not going to want to change very quickly. And I would say one of the key ones for them is counter-positioning. When they started out, the world was dominated by CPUs, central processing units, Intel, AMD. So are you going to beat the big boys at that game? No. They went off and did graphical processing units, GPUs, which at the time were for games, but now it's turned out it's been a home run because it turns out the parallel processing you need for those games works fantastically for artificial intelligence. So I'm not sure people fully appreciate that initial decision that they made and how it's paid off over time. Arguably, they may also have something in terms of a cornered resource, in terms of their understanding of artificial intelligence. They're not just doing the chips now, they're getting into the networking and creating complete data centers. And the branding probably matters a little bit less, particularly in semiconductors, but it does matter in tech. People still will say you don't get fired for buying IBM, or maybe these days you don't get fired for buying AWS to be your data center. In the future, you're probably not going to get fired for buying NVIDIA GPUs. So that's to kind of answer your question about how do we think about which companies we want to be looking at.
And Steve, since you've given us this overview of the 7 Power Strategic Framework, you mentioned some names that have been around for decades and through different cycles. So when you're thinking about a long-term investment horizon when it comes to the tech names, we know Intel, we know Apple, and as you mentioned, NVIDIA, some of these names have survived and gone through many cycles and ups and downs. So if you had to take a look at these names and rate their performance in terms of how they have been able to survive and innovate, what is your assessment?
So I covered the hardware companies, so IBM, Sun, Dell, HP, Apple. Hardware is not the sexy part of technology, and that's been true for a long time. It's kind of migrated to the internet, to software. Now even semiconductors are quite a bit hotter. And yet, companies like IBM and Oracle have survived through many cycles. Many of them have succeeded because of that switching cost. IBM was the dominant computer company in the 80s. Its relative performance of the stock to the market actually peaked in 1987, but the companies continued to do fairly well. The stock in the last 12 months actually has been quite good as they've gotten rid of parts of their services business and actually are growing revenue. But the reason that they were able to buy time is because of the switching costs. People locked into their System 360 operating system, and hard to take all that corporate data off the mainframe onto Windows servers or whatever it might be, Sun Unix boxes. Oracle, a little bit of the same thing, right? Oracle kind of viewed as a long in the tooth software company, but they own the database. That's where your key company crucial data is housed. Very hard to extract that. That's bought them time, so now suddenly they're a fairly important cloud player. Microsoft, another example, right? Microsoft, in a sense, peaked 20 years ago. They had the Justice suit and all that kind of stuff. Ballmer came in. They started to go for Nokia phones, and they were just off on a total wrong tangent. But they came back to their enterprise customer. They still had tons of enterprise software out there, and they leveraged that with cloud. So cloud turns out to be a huge enterprise data center opportunity for them with Azure. Instead of running your data center on-prem, you run it off-prem at AWS, Microsoft, Google Cloud. So that's given them new life, and now, of course, they're invested in OpenAI. So they're the exception. I would say those three are the exception to the rule. There are other companies that have made it through by remaking themselves. But as Clay Christensen taught us, disruptive technologies usually get you in the end. And the reason is not because your management's dumb, it's because they're listening to their best customers. And their best customers want a better mainframe if you're IBM, a better mini computer if you're DEC, a better PC if you're Compaq. And yet the market moves on to new things and to lower margin things quite often. And as Jeff Bezos said, your margin is my opportunity. So for the traditional companies, their margin becomes somebody else's opportunity. There's plenty of companies that I won't list that didn't make it, but I'm somewhat infamous for having written one of the first kind of open letters, as they call them these days, to, at the time, Scott McNealy at Sun, kind of arguing that they had to make some big strategic changes and he had to hire a new COO and all this kind of stuff, which I don't think was fully appreciated at the time by the company, but I think turned out to be fairly true. And the stock tanked, and eventually they had to sell out to Oracle.
And Steve, as you mentioned, some very familiar hardware names that you have covered over the years, but you do have a storied reputation that does follow you. So I know that you've talked to many management teams over the years for the companies that you're covering. Before we move away from the 7-Power Strategic Framework, what would you say are some examples of companies where this wasn't applied in the best manner, and as a result of that, the company learned some very important lessons?
Well, I covered digital equipment back in the day, which at the time was the leading mini computer company. And at one point, they got envious of IBM's mainframe business. And they were like, hey, I think we can get some of that mainframe business. And they came out with a product that didn't sell. Again, in the customer's mind, DEC meant mini computers, not mainframes. IBM was able to block what they did pretty successfully, and it was sort of the beginning of DECs falling apart to some degree, if you will. Another thing to watch out for these days is stock comp. So we've gone through this process over the years of how do you report earnings, right? So yes, we have GAAP earnings, but tech companies tend to fall over themselves to report non-GAAP earnings, which in many cases there's a reason for that. It's useful to kind of look at things that are on a continuous operating basis. But in particular, they tend to hide a lot of the stock-based comp. And one of the companies that I think is particularly bad at this is Snap. Snap, I think, was profitable in 1 quarter of their history. They're unprofitable today, and yet the management team through stock has gotten quite rich. So I think if you look at the message boards, you see a lot of people complaining about what they're doing. So you're really looking for management's common sense that basically are aligned with shareholders. Everybody talks their game, but there's still some people, I think, who are on the right side of the line in terms of having the right incentives aligned with shareholders, and then others who maybe are playing some games.
And I do want to step back and take a look at that 60,000-foot view of tech that you mentioned, as well as the 30,000-foot perspective. So can you refresh your memory and also dive into the 30,000-foot perspective?
Yeah, so the 30,000-foot perspective I would view as those 10 to 15-year waves. And that's become so important because we've seen enough waves now that people have kind of figured out, okay, the mini computer wave's coming, I want to get out of IBM, I want to get into DEC. The PC wave's coming, okay, I want to get into Compaq, I want to get out of DEC. One of the big issues right now, of course, is with the AI wave, what happens to software? I saw a Morgan Stanley report came out the other day where they're arguing there's actually going to be a big 10, 15-year upgrade cycle coming for software. Others would argue that no, with artificial intelligence you can code much more quickly. People aren't going to want to pay tens and hundreds of thousands of dollars of upping their licenses and their seat fees and so forth So the question investors have been asking recently is software dead? Now, obviously that's an extreme view. The answer is likely to be somewhere in between, but that's the kind of critical question that you're going to have as you move into a new one of these 10 to 15-year waves.
So what questions should we be asking when it comes to the next wave?
Yeah, so let's talk a little bit about artificial intelligence. So we have, starting with slide 7 here, I'm going to show some slides from Coatue. Coatue is a crossover fund. They do both public and private investing, and they did a really interesting investor update in the middle of summer, and a slide deck which is available on the internet for that. So Coatue. So what they talk here about is kind of how do we break down that 10 to 15-year wave. And they would point out that initially with artificial intelligence, we're in the early stage, we're creating the core infrastructure, which is the semiconductors, the data centers to do the AI training at this point. So it's very hardware-centric. We're beginning to move into the second phase, where you begin to move this intelligence out to the edge. So Apple's now talking about trying to embed some intelligence into the new iPhones. All the PC companies are now trying to, get on this wave, and we have, Copilot, and we have AI PCs. I'm still kind of wondering if that's a bit of an oxymoron, but in any case, we're moving to the edge. The next wave, arguably, would be something with applications, because with these waves, quite often they do unfold where they start in hardware and they move into software, and then they kind of end up with services. So with AI applications, you're going to have, they're not calling them agents, but you can just imagine, every industry potentially has an application of AI in it. And then finally, you could see AI in physical. So I was watching TV yesterday, and Jensen's on talking about potential wave for industrial AI, and I think this would be another name for that, where you're putting artificial intelligence into real-life objects like cars with self-driving. Robotics certainly is going to be a huge one over time. The recent Meta glasses that were announced are kind of a form of use of AI, so that's maybe how augmented reality becomes something that we actually can invest in over time. So this is one way to think about how we're moving into this AI wave. If we go to the next slide, on slide 8, a big question right now is there's huge investment going into this first stage, right, into these large data centers. So perhaps over to, according to this chart, maybe $2.4 trillion of investment in primarily data centers, and about half of that cost is for GPUs from NVIDIA and others, and about half is for other things. If we want to get a return on that, let's say a 25% return on capital, that would result in about $1 trillion of cash flow over time. And just that $1.8 trillion number relative to other things in the economy, 3% of global revenues and so forth, 2% of GDP. These are huge numbers that we're talking about. So when you're investing in trillions today, the investor has to be asking, okay, when's the payoff coming? When do I see it? And you've got, I think, Microsoft, Meta, other companies kind of saying, hey, look, there's going to be a bit of a gap period here where our margins may get squeezed a bit. It's going to take some time for this to mature. The good news is we saw this with the internet era, right? We have particularly the telecom side, we had all that fiber laid down. It was excess capacity. It was nuts. WorldCom and all that stuff collapsed, but it resulted in the bandwidth that Google and others needed. So the idea today is that the investment's going to be worth it. And all these companies have pedaled to the metal in terms of the investments that they're making. So only time will tell. The financial metric you want to be focused on over time is return on capital. Are you earning your cost of capital? If you are, you're creating value. If you aren't, you're destroying value. And no matter how fast you're growing, you've got to earn that cost of capital. In fact, the faster you grow, if you're not earning cost of capital, the faster you're destroying value. Now, initially in these early stages, you're not going to be earning the cost of capital in AI, but again, the bet from some very smart people is eventually you will. Sequoia, which is one of the famous VC firms, has some papers out also available on the web, and they're showing that there's about a $500 billion, I think it's $500 billion gap of revenue today in terms of what's been invested. And to get that, say, 20-25% return, how much revenue are you going to need? Well, today we don't have much, right? OpenAI has 3 or 4 billion. There's a few other billion on top of that. So we need something like 500 billion of incremental revenue to justify to get a return on the investment that's being made. So we'll all be following that very closely. But I think it's likely to pay off in some form longer term. If we go to the next slide, just to see the investment opportunity and how it's shifting as we shift waves. As I mentioned, the last 10 to 15 years have been very software driven. So names like beginning with Salesforce, of course, Workday, Snowflake, and others. The SaaS index has done incredibly well, software as a service. But now as we've entered the AI wave, it's been really driven by semiconductors. NVIDIA, but also AMD, Marvell, and others. So again, as we saw early in this wave, you're likely to see it being fairly hardware-centric, semis, and to some degree the cloud players. And then finally, if we go to the last slide, slide 10, this is where Coatue looked at AI stocks with at least a 25% return year to date. And they identified 33 names. 17 of those are semiconductor companies. So NVIDIA and GPUs, Apple and PC companies perhaps, and Edge AI. Foundry might be TSMC, Semiconductor Capital Equipment, ASML, KLA, Memory, Micron, Networking, Arista. So there's obviously a lot of tech ways to play this and beyond semiconductors. But I think the new thing is that there's a lot of non-tech ways to play this trend as well. A number of industrial names, probably in the data center, that help you create the full data center. And the big one, of course, is we need more energy. You're starting to invest in utilities as a tech play, believe it or not. Energy companies over time. So we're seeing 3 Mile Island nuclear plant coming to life again, just to give Microsoft some new data centers. So you've got to start to broaden that aperture as an investor beyond classic tech if you want to take advantage of the AI trend.
So a few things that stood out to me. I do want to expand on what you were talking about in terms of gap, in terms of revenue, and what this would look like for an investor in terms of time horizon, so in terms of return on investment. So if somebody is looking at some of these names for an AI play, what does that look like in terms of a time horizon for investing?
Well, I guess it depends on the type of company. Semiconductor companies clearly can be benefiting today. Now, you've got to dig a little deeper and sort of see how much of that revenue is truly AI driven, right? Because you see all these kind of Google search results and looking at earnings calls and how often AI is mentioned and so forth. So everybody's trying to put an AI coating on everything these days to get a higher PE multiple. So you certainly have to look underneath that and see what's real. But for the semiconductor companies, a lot of that is real, and a lot of it's now and probably over the next 3 to 5 years for sure, and then going out over time. For a software company, it's on the other hand maybe more of a threat in the near term. Trying to figure out to what degree are coders more productive using AI. The number seems to be not 100%, but 20 to 30%. Does that mean that I need fewer site licenses and so forth? On the other hand, many of these companies are claiming it's going to ultimately benefit them through software agents and so forth. Then you even have services. Yesterday, Jensen announcing a deal where NVIDIA and Accenture are going to be working closely together. Services tends to have a bit of a longer tail to it. For the established companies, the good news is that they have seen previous disruptions. So companies like Google and Meta and so forth, you typically would say, oh, they're going to be disrupted by this new stuff, because the old companies usually aren't good at the new stuff. But they've seen what's happened in the past, and so they've been quick to jump on these trends. And if anything, as we talked about, maybe they're over-investing in the trend and creating an AI bubble. But you got to give them credit for really moving those ships in a quick direction. For small companies, I'm going to bring up something you're never going to hear from somebody else. But it goes back to that kind of marketing thing that I mentioned before, which is company names. I believe company names are very important. And there's good and there's bad names. Bad names tend to be common names. A common name would be a category name. And this was very typical back in the dot-com bubble, right? So everybody thought, well, I'm going to own the pets category by calling myself pets.com. Wine.com, garden.com. So, I mean, it kind of makes sense. But if you look at the companies that came out of that period, it's Yahoo, Amazon, proper names. So it turns out, I believe, that the idea is that what you want to do is create the most powerful thing for a company is to create a category. You want to be a category creator, and you want to proliferate that category, but you want your company name to be the leading brand within that category, a proper name, not the name of the category. And if you're super successful, they sort of almost name the categories for you, like Xerox. Go Xerox that.
Yeah.
Remy, go Google that for me, right? So that's kind of the ultimate mind share game that you can get. So I would watch for particularly some of the smaller companies to see, do they have good names? One of the companies in AI that's trying to do something interesting is Grok. It's Q, this one, whereas Elon has his Grok AI, so that's a little bit confusing. But it's a proper name, and they're doing a counter-positioning. They're saying, look, what NVIDIA is really good at with GPU chips is training, right? There's two types of work for AI, training and then inference when you actually put it into implementation. So most of it's been training so far, and NVIDIA is fantastic at that. Inference, though, arguably could require cheaper semiconductors, a little bit of a different approach. Grok is saying we're going to focus on that and disrupt, in a sense, NVIDIA as they try to move into inference. So that's highly debatable. But I'd be watching for new names, how they name themselves. What's their strategy? Is it counter-positioning? What are they trying to do? And how aligned is management with what I care about?
And Steve, it's funny that you mentioned searching for AI in an earnings call or even perhaps an annual report, because if you don't have an analyst or associate working for you or with you, you can actually use AI to search for these terms, right? So yeah, before I let you go, I do want to ask you about the data center part of the AI play. You mentioned industrials and how these companies also have exposure. So for people who might be wondering, what does that actually look like in terms of these companies? You mentioned 3 Mile Island and what Microsoft is doing just because of the need for energy as they move forward. So tell me what you're looking at when you're focused on the industrial play.
Yeah, that's a good question, and I'm not quite sure what specific industrial companies they're talking about. I'm sure some of them have components that do play in the data center or maybe in the distribution side. Many of them I'm sure work with utilities in terms of transmission and so forth. I have to say, as somebody who started with mainframe computers, I'm very excited to see the data center have this renaissance, right? It looked like everything was kind of going out to the edge, but over the last 10 years, of course, we've had the cloud, which has reinvigorated the data center. Now we've got, even bigger and better data centers with, thousands of GPUs. It's hard to imagine. I don't know if some of you have, watched the Silicon Valley TV show, right? But they had pictures of the Hooley data center. It's just like fields of servers, and I imagine that's what it's like. And increasingly, you're going to want to put these in maybe rural areas. It's all going to be about what am I close to? Am I close to water, hydropower? Clearly, nuclear is going to get a big boost out of this.
Yes.
And there are companies, trying to now do sort of small nuclear, and hopefully we're going to start to allow regulation to do this faster. But it's funny how I actually did clean tech analyst for a couple years, and which was very frustrating, 10, 15 years ago with solar and so forth. But nuclear was considered bad. Now it's considered green, which I think it should be, right? So there's going to be nuclear plays on this eventually as well. But it's great to see the data center come back, and there's going to be a wide array of plays likely in the industrial and service sectors on this trend.
Well, Steve, I could go on and continue talking with you, but thank you so much for joining me here on set at the New York Stock Exchange, and thank you for sharing your insights.
Thank you, Remy. Really appreciate it.
My pleasure. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro.TV, and you can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us, and have a great day.